What's up, guys? In this video, we're going to talk about how investing is changing. Okay, the landscape is changing, the rules are changing, and it's something that we need to talk about. Let's get into it. So let me set some context here. Let's take you back to the 1950s. Okay, post-depression, people are scared of investing. They don't like the markets because their mother or father or themselves probably lost the money, and either the war, the Great Depression. People are skeptical. Only 6.5 million Americans owned U.S. stock at this time period. You hit the 1970s, inflations are crazy, interest rates are crazy high, but you're starting to see more adoption. You see the emerging of mutual funds take place, and people are saying, look, investing isn't that scary. We can diversify away the risk. It's a lot better investment. But then mutual fund managers obviously, charge these fees on their capital. And so in the 1990s, Vanguard hit and they emerged with the ETF. We talk about this in other videos. That's the exchange traded fund. Now, 1950, 6.5 million American owned stock. 1990, 51 million Americans own stock. Okay, so this appetite for investing is changing. The psychology is different. People are like, okay, you know what? The stock market is actually a place where I can make money, and I should, right? If I ever want to retire, I need to invest. And, throughout this time, obviously there's all these regulatory bodies that are interfering and saying, well, no, you shouldn't, because then there's all these Ponzi schemes and the government's trying to protect these investors and saying, hey, you're not smart enough to make a decision for yourself, so we're going to protect you. So it's just constantly evolving and changing, right? 2002 hits. Fees change. So before that, brokers, you'd have to call a broker to invest, and they charge you a crazy fee to make a trade. And, then they're like, look, you guys are charging way too much money. Let's cut the fee, to a tenth of what it was. People are getting smarter, and people are getting, they want more transparency, they want less fees, and they want more money, as always, right? But yeah, just the overall market is getting more intelligent and saying this is ludicrous. You can't charge these astronomical fees just for making a trade. We can do that ourselves. So, the landscape starts changing there. You see in the early 2000s, E-Trade and Fidelity come out, where these self-directed brokerages, where really people can start having access to managing their money. People are excited about investing. They're starting to buy up real estate left and right and above and below. And then, of course, 2008 financial crisis hits, right? That did a lot. It actually, it's kind of a little bit of a tangent, but, I felt like post-2008, banks were forced to focus on being compliant and being regulated in the right way, which took a lot of their extra R&D dollars. And I feel like they lagged in terms of development and parallel to the rest of the world. So what happens is their technology got worse and worse. And, it didn't keep up with the times, I should say. It didn't get worse. It just didn't keep up with, the evolution of our economies. And so then in the early teens, just the landscape changed, right? It wasn't just a bank that you worked with. That's when Fintech erupted. The emergence of Robinhood and all these other apps and lending and SoFi and all these, insurance products and all these financial products that are, instead of B2B, B2C, right? They go direct to the consumer, and they're like, look, you don't have to do this. Don't look, we'll pay off your student loan debt. It's crazy high rates. And then, get a loan from us instead. We'll pay off all these, just the landscape changed. And what also happened is people started getting more aware and conscious of their dollars. They started getting smarter. Access to information is abundant. Okay, especially, it started in the early teens, especially financial information. That's when you kind of had this emergence of the robo-advisor. Instead of hey, let's pay a financial advisor to manage our money. It's no, let's educate you. You can manage your own money. Let's take this survey, answer these questions about stocks and bond or your risk tolerance, and then here's a recommended portfolio. So, people are getting smarter. They're wanting less fees, and then it was just a couple years ago where they cut fees down to zero. There's no trading fees, and you can more and more people are getting access to investing. I think people are understanding that you need to invest if you want to grow your wealth and you want to retire, retire at a reasonable age, I should say. You've just seen this massive change. So again, let me repeat. 1950, 6.5 million Americans owned US stock. 1990, 51 million Americans owned stock. 2015, 165 million Americans own stock. 56% of households and Americans owned US stock. So there is just this, craze where people are participating in the markets. They're understanding the markets. They're saying, wow, and over time, people are just getting smarter and smarter. And that's where you see this fee compression take place, these robo-advising now. Now, what's next? My opinion, alternatives. I am very, very bullish on alternatives in the coming decade. There are, technologies and companies popping up left and right that provide access to alternative investments for the retail investor. And by retail investor, I mean the average Joe Schmo, right? I'm not talking about these institutions or these super wealthy, just everyday people. And I think people are understanding that, hey, look, these alternative assets provide quite a great solution in my portfolio. That's why more and more people are investing in real estate, and they're doing it themselves. And more people want to be in private equity or venture and want to buy businesses or, be in a hedge fund. But regulation hasn't always allowed it. So in 2010 was when the 506C Regulation D was introduced, which allowed funds to publicly advertise to people, but still, limitations on accredited investor, things like that. But they also launched crowdfunding. It wasn't that great. It was amended in 2016. Guys, 2016. We're talking 5 years ago. Okay, that this happened. So this is brand new. The fact that people can crowdfund and raise money from the public markets. And obviously in this, again, info technology age, people are online and they're investing and they're learning and they want to participate in these things. There has been solutions to the market, right? That are not just private funds on, that only exclusive to ultra high net worth, but they're allowing access to the retail investor, or they're just even the high net worth investor, right? Like a regular person with a $2 million net worth, it's going to be hard to find a really good fund to invest in. And, so there's all these products that are saying, hey, look, I'll do that for you. So, take a look at these couple companies. First up, we got Fundrise. Okay. So this is access to real estate. You don't have to go do it yourself. You can invest in it and for as little as a couple $1,000 and you can have access, to real estate in your portfolio. Okay. Take a look at this next company, Sweater VC. Same concept. Instead of saying, hey, instead of a $2 million check to participate in venture, how about 2,000? We'll go and we'll allocate that into emerging companies for you. No, we're actually interviewing them on our podcast here in a couple weeks. So look out for that. And then you have, Titan Invest. It's like a hedge fund. It's an actively managed portfolio. It's not regulated as a mutual fund, which is different because then, you can't take different riskier positions. It's regulated like a hedge fund and you can have access to, a hedged fund, right? How it originally started. So, you're seeing the landscape change. People are getting smarter. The sophisticated market want access to these products, and the market is giving it to them. So be aware of this, guys. Figure out how you fit into the puzzle. Is there, obviously these three companies that I just mentioned, they're kind of like the only that I've seen in their sphere. There's not that many competitors that are doing exactly what they're doing. The field is wide open, okay? Participate in it, identify these trends, and instead of just watching the world change, be a part of it. Just try and anticipate what's coming and, look at these patterns over time and make something happen out of it. Have a good one, guys. We'll talk to you soon.
Keep dancing with the devil, but it is alive.